Good morning. I'm Joanne Jobin with VID Media, and welcome to the Vox Royalty Town Hall Forum. We're here this morning with CEO Kyle Floyd and CIO Spencer Cole, who will discuss Vox's performance in the royalty sector. And now a few words about the company. Vox Royalty is a metals commodities dividend-paying growth story, currently trading at less than its intrinsic value. Furthermore, since 2018, Vox has been the leader in accretive growth in the mining royalty industry space. Metal commodities are expected by many to be one of the best performing asset classes for price appreciation in 2023. Vox, with its exposure to gold, silver, copper, and industrial metals, is well positioned to capitalize on higher commodity prices as their revenue, margins, and cash flow increases. Today, management will discuss their differentiated capabilities in generating excess value for you in the commodities sector. And before we start, we do have a video to share with you. So Todd, roll the tape, please. Thanks, Todd. Now, before we get started, I do want to remind everyone that if you do have questions for the company, please place them into the Q&A tab at the top, located near your chat section. We will answer as many questions as we can at the end of the presentation. And now I'd like to turn it over to Kyle and Spencer. Gentlemen.
Well, Joanne, thank you very much for the warm introduction. And it's a pleasure to be with everyone and representing Vox Royalty Corp today. We believe we have a tremendous company trading at a discount to our NAV and realizing one of the fastest growth stories in the industry at accretive values. And we're excited to tell you more about this. I will point you to our forward-looking disclaimer. Please note we'll be making forward-looking statements. We find ourselves in a very unique macro environment. And while a lot of the world is struggling with high inflation and high interest rates and challenges that come with that type of macro environment, we are finding ourselves in what is a very buoyant metal price environment, essentially across the board. And we believe that Vox is uniquely positioned to capitalize on this high metal price environment. We noted that over these past inflationary trends and into these cycles, mining commodities have done exceedingly well. It's been one of the best performing asset classes. I believe there's been studies done that over the last 9 inflationary regimes, metals have been one of the very top performers. And royalty companies within that macro environment tend to do exceedingly well. Royalty companies over the last 20 years have outperformed essentially every commodity-based benchmark you can compare them to, whether that's the ETF, whether that's physical, whether that's mining companies, and even the NASDAQ and S&P in their own right, mining commodities and royalty companies specifically have outperformed in these environments. So we're very pleased to be where we sit today. We have macro tailwinds behind us, and our business is capitalizing on those tailwinds. Things to note about the royalty industry is when companies buy good royalties, they tend to do very, very well in terms of the appreciation and value that they realize. And this is because of some of the unique characteristics around royalties in that they're typically perpetuity interests on revenue that these mining operations are realizing. So we're taking a top line percentage of the revenue that mining operations realize, and we are not affected by the significant capital intensity that mining companies face. Therefore, it's upside without a lot of the downside, and we're not contributing the capital to that growth. So it's a really unique form of leverage to metal prices and operating mining assets, and the growth of mining assets all around the world. And these 3 case studies exemplify what Vox is looking to achieve within its portfolio of purchasing third-party royalties. These assets, I'll note that they are not our assets, these are case studies, have done extremely well for the very large royalty companies in our industry, Franco-Nevada, Royal Gold. But this is what we modeled our business after, finding value in third-party royalties with royalties that can deliver these types of characteristics for growth and value creation for our shareholders. And so we believe we're unique in our capacity to deliver that accretive growth for our shareholders. We also believe that right now, the way Vox is positioned, the market is not understanding the value that we're driving for our investors. And what we note here is there's a tremendous disconnect between our valuation and our net asset value. What we're delivering in terms of revenue growth and accretive revenue growth is really leading the industry in all respects, and we're paying a dividend. Our ability to continue finding value in a sector that is competitive, that does have other royalty players, and our ability to be outside of those competitive waters with the competitive advantages like our royalty database, our team that's been in the industry for 50 combined years and been involved in more than $1 billion of royalty transactions. We have unique capacities to find value and deliver value for our investors. And this slide is just really a high-level example of some of the ways that we're doing that for our shareholders. So I'm excited to bring Spencer Cole on. Spencer is our Chief Investment Officer. He was the founder of Mineral Royalties Online, the database that we acquired in 2019, and has helped really build a lot of the success of Vox. So Spencer, I'll hand it over to you.
Yeah, thanks a lot, Kyle. So a little bit about Vox and its capital structure. We have a very tight capital structure, only 45 million shares on issue. And importantly, management owns 15% of the company, and our families own stock on top of that 15%. So when you think about, management being aligned with investors, that's a core principle of Vox. We have no debt on the balance sheet, net cash that's growing now that we're in a free cash flow generation position. So a really strong balance sheet to continue acquiring new accretive royalty opportunities. At a very macro level, our royalty portfolio consists of 62 separate royalties. We are precious metals dominant, and as a subset of that, heavily weighted towards gold. But our core focus really is on acquiring, accretive or value additive royalty opportunities across the hard rock commodity landscape. So, for example, where we see a mispriced and valuable copper royalty or a lithium or vanadium royalty, we'll happily look at acquiring that. We're not just fixated on gold royalties, but we do have quite a healthy weighting towards both precious, base, and battery metals. Importantly, from a geopolitical risk perspective, we offer investors extremely low geopolitical risk, some of the lowest in our entire $70 billion royalty industry. That's sort of the cornerstone of that is our weighting towards Australian mining royalties. We're actually the second largest holder of mining royalties in all of Australia, second only to the $30 billion Franco-Nevada company. And obviously being second to a $30 billion company when we're a $150 million company is not such a bad position to be in. Australia has been a key growth focus for us. We view particularly Western Australia as the best mining jurisdiction on the planet. And so we've grown a lot at great value in Western Australia, and we'll continue to expect to grow in Western Australia. So 80% of our portfolio is weighted towards Australia, Canada, and the United States. And then from a stage of development perspective, of our 62 royalties, 7 are currently producing. And in the near term, we expect, based on what's coming down the pipeline from our operating partners, we expect that has strong potential to grow to 10 and north of 10 producing royalty properties. So a little bit about where our royalties are located. As I touched on in the last slide, we're heavily weighted towards a tier 1 mining jurisdiction in Australia. So a lot of our revenue and our growth is coming from Australia and specifically Western Australia. When you look at, I guess, the global flows of capital within our industry, it's important to note that the gold price, when you think about it from an Australian dollar denominated perspective, has been at near record levels for the last 4 years. Trading at around anywhere from sort of $2,400 to $2,700 per ounce in Australian dollars per ounce of gold. So what we see consistently in Western Australia is there's been an abundance of capital for our operating partners who are looking to explore, develop, and operate mines, particularly low-risk gold mines. So, Australia and Western Australia have been an incredible jurisdiction to have royalties in recent years, and we expect that trend to continue. What this strong base of royalties in Australia, US, and Canada allows us to do is where we see really attractive returns outside of those core geographies, we're able to bring that value in for our investors, at really compelling prices. So, for example, we acquired what is now a producing gold royalty in Nigeria. And while Nigeria is not the top of everyone's holiday wish list, because we saw a rate of return there that was quite attractive. So within a space of 3 years, we expect to make 5 times our money on that gold royalty investment. And so our ability to leverage our really low geopolitical risk allows us to bring in those types of returns outside of our core geographies. And then just in terms of stage of development, I touched on the fact that we have exposure to 7 producing assets. So unlike a lot of other explorers or developers who have single asset risk, Vox offers investors the benefit of having diversified exposure across 62 separate mining assets, 7 of which that are in production, and that's expected to grow organically without any additional capital from Vox to north of 10 producing royalty assets in the near term. So God forbid the Vox management team got hit by a bus, our royalty portfolio would continue to organically appreciate and grow in value as these development stage royalties move into production. And that obviously has quite meaningful consequences for revenue and free cash flow generation that supports our dividend policy that was only just introduced late last year. So industry consolidation is underway. This has been quite a hot topic in our $70 billion royalty industry over the past 2 years. So in the last 12 months alone, there have been 4 separate mining royalty companies that have been acquired. So mergers and acquisitions they are top of mind for a number of different players in our industry. And I think part of this is a function of the inherent scarcity of high quality royalties. So companies that offer strong growing revenue, that have exposure to a large number of different royalty assets, with very low geopolitical risk. Investors continue to place a premium on those types of royalty portfolios, and they are inherently scarce. So we expect that this theme of industry consolidation will continue in our industry, and it's I guess it bodes well for the coming quarters and years, for all participants in our entire royalty industry. And then I guess just to recap on some themes that Kyle touched on at the outset of our presentation, why is now a good time to be hearing about Vox and to be learning more about this unique mining royalty industry that we're in? So Kyle touched on the fact around valuation, against all objective metrics, whether you look at on a revenue basis or a fundamental valuation basis, Vox continues to be significantly undervalued versus our peer set. I guess, this is sort of corroborated or reinforced based on the independent brokers that cover us and their, consensus buy recommendation and their target prices well north of where we're trading today. Our management team is completely aligned with investors, given we own 15%. 4 of my brothers and sisters own Vox shares. So, on a daily basis, I'm getting a lot of interesting questions from siblings that are shareholders of Vox as well. So we are truly aligned with investors, and we've been buying on market ourselves over recent months as well. We've had a number of key catalysts in the last few months. So we initiated a maiden dividend policy. We're one of the smallest royalty companies in history to initiate a dividend, and that's really a function of the underlying confidence we have in our growing revenues. We just listed on the NASDAQ stock exchange in January. So last month, we rang the NASDAQ closing bell in Times Square, which was an incredible milestone in the company's 10-year history. But it's not only backward-looking catalysts. There are a number of really exciting milestones coming up, expected in the coming months and quarters for Vox investors. Kyle touched on this a bit earlier. One thing that has really taken the market by storm has been just our exponential revenue growth. Year on year, last year we generated over 160% of annualized revenue growth. But we really think that our portfolio is only now sort of starting to mature, and this is really the tip of the iceberg in terms of where we see the potential of our portfolio and our company. Industry consolidation is underway, as I touched on, and that bodes well for all participants in our industry. And then finally, in terms of the portfolio of diversified exposure to 62 separate royalties with very low geopolitical risk, we couldn't be more excited with the organic growth and organic developments we see in our royalty portfolio and what that means for revenue, free cash flow, and dividend potential going forward. So with that, I'll hand back over to you, Carl.
Well, thanks, Spencer. That concludes our prepared remarks. Joanne, happy to now get into Q&A.
Excellent, gentlemen. Let me just turn over to the Q&A here, see what's been published. Just remind everybody that they can certainly upvote their questions by using the thumb emoji. So our first question, please outline your main global objectives for royalty acquisitions in 2023 and which district are you focused on, if any? And I guess that goes along with the next question, which is what catalysts are you most excited for in 2023?
Well, I'll start with the question around catalysts for 2023, as it definitely goes in line with the first question of what assets are we targeting. As Spencer noted, we've had some of the most significant growth in number of producing asset count. When we went public in May of 2020, we had 1 producing asset. We now have 7 producing assets. We've realized 160% revenue growth from where we were in 2021 to the end of 2022. That is the highest growth in the industry, certainly on a per share basis. And so we've been really excited to deliver that growth and that value for shareholders. That's continuing organically within the portfolio. We're going to be bringing on additional producing assets with no further capital from Vox. And so you're going to continue to see over 2023 more assets come online. And really what's driving a lot of our growth is expansion from the already producing assets. We went out and found royalties that were anywhere 2 to 4 years out from production. The technical team on the front lines of our business is very sophisticated, and it's unique in the royalty model that we have mining engineers and geologists. You might assume that's the case with most royalty companies, but it's actually not. We have technical people on the front lines of our business development efforts, and they've found great assets with great royalties that we found at phenomenal value that are now organically growing within the profile of the business. So when we look at 2023 catalysts, it's really just the continuation of what is a very strong business with underlying competitive advantages, where the assets that we've cherry picked to put in the portfolio are realizing expansions, and that's compounded by high metal prices. So our 2 main producing assets right now, if you wanted to really focus on value, would be the Wandmuna producing iron ore royalty. That's undergone an expansion at a tremendous pace. When we bought that royalty, it was expected to do around 5 million tons, and they've been permitted up to almost 13 million tons over the last 6 months. The other major expansion that we've had to our benefit is the Janet Ivy producing gold royalty. We bought that royalty pre an expansion that made it the largest heap leach in all of Australia. So those are two examples of catalysts that are not yet priced into Vox that are happening this year, alongside other assets that are coming online that are already either in construction or procured mining contractors. So we're really excited about the portfolio, and we're going to keep buying a lot of the same. We're able to find value that other royalties can't. That's because of our royalty database. That's also because of our technical team. And it's also because as a team, we've been in the industry for over 10 years consistently throughout our business development professionals. So our ability to look and find and understand value in the royalty space, certainly for any company sub $500 million, is relatively unmatched. And so when you look at where we're going to continue building, Australia, we believe that we have a huge competitive advantage there. And we're able to continue finding value, even in some of the competitive jurisdictions like Canada. We announced a few deals with Canadian counterparties last year where we were able to find good value in Quebec and Ontario. And we've even found good value in Nevada. But our real competitive advantage, and what I think is really unique about Vox, is we are continuing to find and build our royalty portfolio in Western Australia, which was ranked #1 in terms of mining jurisdictions for investment by the Fraser Institute. And I'll tell you, from a practical perspective, I don't think there's any jurisdiction quite like Western Australia in terms of having consistency of rule of law and being able to take it with amazing professionals and amazing geology, and then being able to take a project from exploration into production and on a very efficient timeline. We're seeing certain projects go from exploration to in production within a matter of a couple of years. That's unheard of in most of the world, and it's happening on high quality projects with high quality management teams. And oh, by the way, we have 3 of our key business development executives are also Australian. So that's one of our key unique competitive advantages. So to the question of where could you expect to see more deal flow from us, I would expect Australia to be one of the centerpieces of that growth.
Great. And it sounds like you've got an amazing growth profile. And as I used to say when I was with Ely, you've got secret sauce with the management and also with your database. So
Absolutely.
with all of this growth profile, what is the market missing on Vox? Why is it so undervalued given its performance and its future performance?
Yeah, Spencer, I'll let you address that, and then I'll fill in around the edges.
Yeah, it's a good question, Joanne. We ask ourselves that question, as a management team all the time. And, I think if you, on one of the earlier slides, when you look at our growth, particularly our sort of organic revenue growth, it has been sort of an extremely high growth period for the company. As you see, we've grown from basically, pre-revenue in 2020 to, I don't know what that percentage is, from 100,000 to 9.7 million, but it is exponential. I think the market is still taking time to catch up to the amount of revenue and sort of free cash flow that is coming from our portfolio and that is expected to grow. I mean, announcing last month 160% year-on-year revenue growth is sort of it's sort of hard to fathom, and we think the market really doesn't fully understand that and hasn't priced even a fraction of that in. It's interesting that the point around our weighting towards Australia, Joanne, because we have such a heavy weighting towards Australia, but we think there still is quite an irrational discount that the market and North American investors are applying to a lot of our Australian royalty assets, for the reason that those mining companies, even though they are multi-billion-dollar companies, aren't listed in North America. From our perspective, if it's a $10 billion ASX-listed gold miner, we think the royalty revenue and the cash flow that comes from that royalty should be valued, as high as an equivalent Nevada royalty, if not higher, because of the quality of the geology and the jurisdiction in Western Australia. Whereas a lot of our North American investors, they still place this sort of valuation premium on, say, a Nevada gold royalty or a Nevada gold royalty revenue. We think that is sort of a short-term irrational discount. And as our Australian royalty revenues continue to grow, we think that irrational discount linked to some of our Australian royalty assets will be eliminated. That's been, I guess, another sort of interesting aspect.
And Spencer, I would add to that. I think a lot of the growth that we've realized has been lost in the volatility of the market over the last 18 months. If you look at the success of the business over the last 18 months, it's been significant, highly accretive growth, revenue growth, margin expansion in an industry that actually is seeing margin contraction generally as inflation has eaten away a lot of the margin of the mining companies. And frankly, a lot of the royalty companies are being forced to pay 1.5 to 2 times NPV or NAV to acquire royalties. Their margins are also getting squeezed because they're having to give up very, very high prices to obtain royalties, where we've been able to continually deliver in terms of finding value for our investors in the royalties that we brought into the portfolio, and then the success of those royalties once they are there. And that's what we call our organic growth. So a lot of our organic growth has happened over the last 18 months. The market has not paid attention to it. That's one of the reasons why I think there's a huge opportunity for investors here. And you can see the tangible effects of that growth. We're paying a dividend now. We've had exponential growth over the last 2 years in terms of royalty revenue. We have one of the best portfolios in terms of development stage growth. Joanne, I know you have a lot of experience with royalty companies. We have great cash flow growth right now, but there's a compounding factor that's happening within the development stage profile that of assets that we've brought into the portfolio. These are really great assets, exceedingly long mine lives, very quality projects that are ramping towards production and that we're really excited about. Meanwhile, since we went public to now, we went public at a premium to NAV, and now we're trading at a tremendous discount to NAV, despite the very significant growth in all of the, what I would call the main metrics that investors should be paying attention to. So we believe that equates to a huge opportunity for investors, and a lot of that I believe has been missed because of the volatility and noise in the market. One other thing to note, Spencer touched on possibly some of this disconnect in understanding Vox's value in a public market context stems from Australia. And for a lot of North American investors, the Australian mining markets might as well be on the dark side of the moon. The reality is that Australia is, especially Western Australia, is by far and away the best geology for gold and iron ore. When you look at what's in our portfolio, that's what dominates it, because that's what dominates the Australian geological complex. What you find there is world-class geology in those mineralizations. You are finding assets that are expanding. Our 2 main producing assets right now have undergone and are undergoing huge expansions. That is really atypical for a royalty company our size. Most royalty companies our size are paying very big dollar amounts to bring in royalties at premiums to NAV. Those assets are either going to take a long time to get in production or a very steady state to declining assets. That's very different from Vox, and it's because we have that inherent capability to find value in Australia as that jurisdiction. It's world-class geology, world-class people, world-class permitting in terms of consistency and speed. And that, I believe, ultimately is going to be reflected in our portfolio. We don't believe that it should trade at a discount. We believe it should trade at a premium, because if you compare that jurisdiction to the best jurisdictions in the world, it stands out as what we believe is the best. So ultimately, the second largest holding of mining royalties in all of Australia is Vox's portfolio. We believe ultimately that's going to carry a premium valuation because the geology and the people and the productivity of these mines, both in production and development stage, are basically going to demand that.
Okay, well answered. So I noticed in your shares outstanding, I mean, you're well under 100 million. Would there be an opportunity for more shareholders via an equity raise in the future?
It's a good question. The reality is, I think we're really unique as a junior royalty company right now in that our balance sheet is extremely strong. We're cash flow positive. We're building cash. We're obviously paying the dividend with that strong cash flow. And we're really in good position to continue finding accretive royalties without going to the markets. That being said, we always have flexibility in our business. We certainly would have demand from existing investors and we believe new investors if the right deal came along that required us going out and raising capital. But right now, that's not in the plans.
Okay. Next question. Here's a great question. I used to get this question all the time. Wouldn't it be better to reinvest cash in more royalties instead of paying a dividend?
Yeah, that is a great question, and it's a question we've received from a few different folks, in recent months since we announced the dividend. Look, I think the reality is when Vox was created 10 years ago, we were created by investors for investors, and we've always been an investor-driven business first and foremost. And, the great part about our business is, we have the ability to allocate capital to new royalty acquisitions, based on our own sort of returns thresholds and our own preferences. Being an investor-driven company, there's obviously some investors that are driven by, yield, some investors that are more growth-focused. We think the current dividend policy that we initiated late last year is meaningful. It's one of the highest dividend yields in our industry. We think it has potential to grow. And importantly, in answer to the question, we think it still gives us flexibility to allocate capital to new royalty deals. So, I think that the challenge with any management team is going to be you can't keep everyone happy. It's going to be a balance between rewarding investors who, I guess, have been supportive shareholders for years, and in some cases almost a decade, while still balancing those objectives against being able to continue growing accretively. So we had a lot of robust discussion around when was the right time for a dividend, and we felt that we had so much confidence in how our assets were growing and performing that the right time was late last year to initiate this dividend. I don't know, Carl, if you want to add to that.
Yeah, no, well said, Spencer. And I think also, from our standpoint, the initial investors that gave us the first $7.5 million that came into Vox almost a decade ago, that's almost a 30% yield on that initial investment. And I think as we look forward, ultimately, you have to return capital to shareholders. That's either through a sale, that's either through a dividend, that's either through share buybacks. And so our business, while yet still small and still growing rapidly, has the capacity to start returning some of that capital to shareholders and continue to grow very accretively and aggressively. So, we viewed it as a nice balance where we're able to give some capital back to our shareholders, demonstrate that commitment that when you start paying a dividend, it also enforces discipline in terms of what you're buying. Is it truly accretive? We've seen runaway spending from royalty companies buying assets at 2 times NAV or 2 times NPV. That means a lot is going to have to go right for you to get your money back, let alone make a return. And the dividend enforces a lot of discipline to make sure that we continue to deliver accretive growth for our shareholders. So there is a preponderance of reasons for the dividend. We obviously hear some of the feedback, which is, Warren Buffett is against dividends. His comment is, you have very good uses of that capital. Why not keep it in the business and deploy it? We took a more balanced approach, and there was an abundance of reasons to taking that balanced approach.
Okay, and staying on the dividend question, and you've kind of answered some of this. Would there be anything to potentially impede a continued payout, or actually increase a payout in the next 2 to 3 years, for example?
Well, I'll point to what we said before we actually initiated a dividend policy, is that if we believe that the cash flow profile of this business, and again, if you go back to 2020, it's premature to be talking about dividends, but in 2021, we would get asked this question of what is the dividend landscape for Vox? And we said, look, we believe that the cash flow profile of this business is going to well support a very long-term dividend. And that when we came out with a dividend, that we would believe it would be sustainable and also capable of growing. So, we're very confident in the cash flow profile of our royalty portfolio. And I would say that we're confident that this dividend has the capability to grow as well.
Excellent. Okay, next question. How are the commodity markets impacting Vox at this time?
Yeah, it's a great question, Joanne. Look, I think there's a few different ways we could sort of tackle this question. One, or maybe break it into two buckets. One is how is that impacting sort of organic or our existing royalties, and the second part of that is how is that sort of informing or influencing our deal pipeline. On the first category, Carl touched on this at the outset of the presentation. We are in an extremely buoyant metal price environment. I know that there is a lot of doom and gloom in the market right now, and the word recession never really, makes people overly sort of excited generally from a macro perspective. But, you look at the underlying basket of commodities that we're exposed to, whether it's gold, copper, iron ore, vanadium, these prices, for the large part, are at near record highs. So, in terms of our operating partners, whether they're exploring, developing, or expanding our royalty properties, the underlying markets and prices they're selling into right now are extremely buoyant. So, we continue to see, a lot of tailwinds with that high basket of current commodity prices. And, there will be short-term volatility, across individual commodity prices, but on a sort of basket-weighted approach across our key commodities, prices are extremely buoyant, which continues to support sort of our confidence in new development stage assets coming into production.
Spencer, before you handle the second part of that question in terms of what it's doing to our deal pipeline, because I think that's a good segue into what the pipeline looks like based on these prices. But Joanne, and you know this because of your royalty experience, and I think a lot of the audience probably has been generally exposed to this concept, but these high metal prices really compound so aggressively in the favor of the royalty company. So for instance, if you have a 1 million ounce gold deposit and the metal price that they built the reserves around was, say, $1,500 an ounce, what we're seeing is in Australia, we have metal prices that are way higher than most of any of the operators expected it to be. And so what you're seeing is the cutoff grade's getting lowered. So a 1 million ounce deposit is now looking like a 1.5 million ounce deposit. Well, that's also encouraging the mining company to go explore around the edges, satellite deposits, extensions to the ore body. And so now it was a 1 million ounce deposit when, say, Vox bought the royalty. Based on the cutoff grade getting lowered, which means more ounces come into the mine plan, you're now at 1.5 million. Then they go and they explore the extension opportunities that was previously lower grade, lower than what would have been economic. Now that is now economic. So you're seeing in some instances, mine plans that were built around 1 million ounces become multiples of that. And remember, we're not contributing any of the capital for that growth. And then the mining company, it's incumbent on them. They usually then go increase production. So you have this compounding factor of increase in reserves, increase in production, all multiplied by a higher metal price. And the difference for us, and why I think the royalty company actually has far more upside than the mining company, is that some of those ounces are going to be marginal in terms of their profitability. They're all essentially 100% profit margin to Vox. That is the power of good royalty companies finding good assets. And we have a lot of assets undergoing expansions because of these sustained higher metal prices, where the contrast between us and a lot of royalty companies is they have a lot of their asset base that's not going to be in production for a decade. So when you're discounting back the value of a higher metal price, it has far less impact than it does on our business, and it's very positive for our business. So to add on to what Spencer said, I want to make that distinction that Vox is very well positioned to realize gains because of these high metal prices for our investors. And I think that gets lost amongst a lot of the noise in the royalty sector. So Spencer, sorry, I'll turn it back to you in terms of what that means within the business development context. Thanks.
Yeah. So I think just as we, in terms of metal prices and their influence on our deal pipeline, a lot of our core focus really is, Joanne, on secondary royalties, I guess similar to Ely was in Nevada. We're typically transacting with groups that are either prospectors or families of prospectors who've held a royalty from discovery, in some cases for decades, or groups, explorers or developers or producers who've held a basket of non-core royalties, similar to First Quantum that we transacted with a couple of months ago on some portfolio of Canadian royalties. I think with the global macro condition that we find ourselves in today, we're seeing a really step change in the number of interested and willing counterparties who are open to selling their royalties at this point in time. So, for example, if you're a prospector and let's say a larger percentage of your wealth is tied up in either property or sort of junior explorers, if you are sitting on paper losses on both your property portfolio and also your junior exploration holdings, equity holdings, all of a sudden, if you have a liquidity event and you want to put your kid through college or you want to buy that new house, the royalty contract is the most fungible asset that you can sell. So what we're seeing right now is an influx of sort of willing counterparties, in some cases groups that we've been in active dialogue with for years, literally this morning we were talking about a deal where we've been chatting with the counterparty for 7 years to buy their portfolio of royalties, and all of a sudden, with this sort of macro environment that we find ourselves in, with other assets sort of perhaps slightly depressed, a lot of parties are interested to transact in their royalties. So everyone will tell you their deal pipeline's never been better, but I can tell you hand on heart that we're inundated with opportunities right now, and almost all of them are sort of bilaterally sourced opportunities where we've been sort of proactively dealing with these royalty holders for, in some cases, up to 7 years.
Wow, that's a long time. But these, as these deals ebb and flow, and they come up and they rise, and they, eventually they get done. But you certainly have to be patient in some instances.
Yeah.
I'm seeing so many questions on consolidation for yourselves. Like, where do you see yourselves in 2 or 3 years? I mean, do you see yourselves as an acquirer or as an acquiree? That's the question that's being asked.
No, and it's a great question, Joanne. I think from a Vox perspective, management owns 15% of the business. We're extremely aligned with our shareholders. We've said that from day one. We are a shareholder-driven business. And so we are planning on this company being around for 20 years. That being said, consolidation is certainly a tailwind within the industry, and it's doing a couple things. One is certainly it's shrinking the investable pool of opportunities for investors. There's less royalty companies to invest in, and that is a meaningful tailwind to Vox and the companies left in the space. We're also seeing some of the long-standing businesses that have been around for maybe more time taken out of the industry. And so with Vox being around for almost 10 years, it's limiting competition for investors. It's also limiting competition for what might be out there in terms of accretive opportunities. And so there's an overall just fundamental benefit to Vox. And what you see within our business is the fact that we've been in the industry for 10 years, our value to investors continues to compound. That's why when Spencer says our deal flow is better than it's ever been, it's compounding year after year because we've invested in our capacity and capability in terms of finding great deal flow. So a lot of the industry is consolidating because they can't find good royalty assets at good valuations anymore. That's the reality. Our business is very different in that we continue to find unique opportunities. A lot, I saw a question about the royalty database. This royalty database, when we bought it, was 7,500 proprietary royalties. It's the world's largest proprietary database of royalties. It now sits at close to 9,000. Our ability to continue to find uncompetitive deal flow is why we've deployed about $40 million US into royalties. Based on last year, we did approximately 10 million top line. That's a 40% return on invested capital. The rest of the industry is generating close to 1 or 2% return on invested capital. That's the difference between us and everyone else. That's what's driving consolidation in the sector is if that's the type of return you're going to get on your capital, there are M&A opportunities that are very accretive for certain companies to be making. You can look at us. We would fall in the accretive category for just about any royalty company out there. That being said, we still believe there's a long way to go for us in terms of being able to create alpha in the sector ahead of everybody else in the industry. So we'll see what happens. But right now, we continue to be focused on building this business, for the long term.
Yeah, Joanne, just to add to Kyle's point there, we get a lot of questions about the database. And I guess one relevant example is later this year, we expect one of our gold royalties is going to move into production. It's the Mount Ida gold royalty in Western Australia. So this was a royalty that we identified in the database a couple of years ago. It was sitting in a shell company that was repurposed as a hearing aid technology company. We approached management and we hammered out a deal with them. They said initially, no, we don't own any gold royalties. We're a hearing aid company. And we said, no, in our database, we can see your shell still holds this royalty contract. So, we acquired that royalty for $200,000 based on broker evaluations. Brokers expect us to make, north of 10 times our money on that investment. And that's coming into production later this year. That's just one of many examples we could share with you where, we're able to use this deal sourcing advantage to bring in really attractive royalties at great value for our investors.
Great. And, in this industry, you also have to be smart about the royalties, but you also have to be scrappy. You have to dig deep to go and get them. I certainly learned that with Trey Wasser at Ely. Okay, so let's turn things around a little bit and speak about some of the metals that you have in your portfolio. You talk about the industrial metals, and because critical metals is such a hot topic right now, are you also looking at the EMs, the other critical metals, lithium, vanadium, all of the other ones?
Sure, Joanne. And in the portfolio already is vanadium. There is copper. There is nickel exposure. So we have a very, very good mix of commodity exposure that we're seeing benefit our shareholders in our business in very meaningful ways. We believe that we've lowered the beta or the risk in our portfolio because we're exposed to really so many metals that have really been buoyant in price, far greater than our expectations and probably even greater than the market expectations. And so across the portfolio, yes, we are a precious weighted portfolio of royalties, but our focus is on finding value. We are seeing more battery metal deals. We are seeing more critical metal deals. And that's a function of sustained higher prices and a lot of these assets now being closer to production. Our focus is finding assets 2 to 4 years out from production. That's where our mining engineers and our geologists and our advantage in finding third-party royalties really creates the alpha for investors. And so, yes, across the board, we're evaluating lithium, we're evaluating nickel, we're evaluating copper. And I believe our matrix of metals in our portfolio will ultimately yield the highest value for investors. And coming back to the consolidation comment is when we're able to continue creating this value and the market is basically buying royalties in the third party context at 1.5 to 2 times NAV. And Vox has consistently demonstrated it's buying royalties at 0.1, 0.2, 0.3 times NAV. And that validation is in our revenue. Those are assets that we bought 2 to 4 years out from production, and they're coming online and they're generating the returns that we expected. Spencer mentioned that we bought a royalty from a hearing aid company. We bought a royalty from an automotive parts company. We bought a royalty from a telecom business. These span from gold to copper to iron ore. We are uniquely positioned and capable in terms of finding value, and that's across the metal spectrum. So yes, for the investors interested in critical metals, I think you'll continue to see Vox expand that exposure because there's better assets now for us to get that exposure with. That was probably one of the limiting factors if you look back at our business over the last 10 years, is that there was not the clarity and de-risking that's happened across the space that's now happened. So we will take advantage of that for our investors, but we will not pay 1.5 or 2 times net asset value for royalties because again, that's how a lot of the industry is growing. And I think that's overall deleterious to creating shareholder value. That means there's a lot of things that have to go right just for investors to get their money back versus Vox buying consistently assets between 0.1 and 0.4 times NAV. And we're able to continue generating that alpha across the metal space.
Excellent. And what is the timing on your 3 additional producing royalties?
Yeah, so Joanne, it's there's as I touched on earlier, we've got a few assets that are in construction at the moment. So our Mount Ida gold royalty, they're targeting commercial production around the middle of this year. We've got another gold royalty in Western Australia called Bulong. That they're targeting a commercialization decision within the next month. That operator that's just outside of Kalgoorlie in Western Australia. We have a number of other assets that are rapidly moving through development. Another royalty that's actually in production now, the asset is in production, is our Brits vanadium asset. So this is a fully integrated, one of only a handful of fully integrated vanadium production operations in the world. We have a royalty on the eastern extension of the current open pit. So, from a development risking perspective, it's literally just as the ore body's mined further to the east, it moves onto our royalty area. So, we expect that has quite strong production potential over the coming quarters. And that would be a mine life that's sort of multi-decade based on the existing resource. And And then we have another vanadium royalty that's sort of shovel ready in Brazil as well, called Pitombeirus. So, we have a number of assets that over the coming quarters we expect to move either into production or towards production. That's just a brief snapshot of some of the more advanced ones that we expect to update the market on in the coming months.
Excellent. And we have one final question. We are at the top of the hour, so once this question is answered, I'll close it out. But what is the average size of the royalties that you have purchased? Where do they tend to sit?
So if you look at early days in our history, and I think it's one of the really unique things about Vox is that we were private for so long, and there's no way to hide just based on the merits of promotion or market hyperbole. It really actually steeped us in finding value. And so the early days with only $7.5 million worth of capital, we had to be very selective in what we purchased. Ultimately, our average transaction size between 2014 and 2018, 2019 was about $500,000 per royalty. And now what you're seeing is that with the access to lower cost of capital, our average transaction size is probably closer to $2 to $4 million. And so that's something that we're really excited about. We believe that we've hit kind of that foundational level, and we've now kind of hit that inflection point to where we continue to see accretive opportunities in up to the $50 million to $80 million type of profile for asset acquisitions. That's been too large for us as a business to aggressively go after and secure. It would have either outstripped the balance sheet, or we didn't have the strategic partners to execute those types of royalties. There was an abundance of reasons that made those deals difficult for us to execute. So as you said, Joanne, we've been very scrappy. We've been able to find value. We invested in our competitive advantages and being able to do that. But there was more scalability that was not unlocked yet. And I think we've now unlocked that ability to scale our business. I think you'll see our average transaction size increase from what used to be, call it $500,000 to something more like $4 to $8 million is probably what ultimately ends up being our average transaction size. That being said, we're going to continue tucking in smaller acquisitions because, like the royalty that we acquired from the hearing aid business, we bought that for $200,000 right now based on what we see from a tonnage perspective. That can ultimately be something like a 50x return on invested capital. We've realized multiples on invested capital to date with a lot of our royalty and what's in the portfolio already. So we're excited to continue delivering value. Our business is very, in a very unique position to continue to scale accretively. So I do think that you'll see the average transaction size increase a little bit.
Thank you very much. Now, as I mentioned, we are at the top of the hour and we are going to be ending our town hall forum. But before we leave, Kyle or Spencer, would you like to say a few words to the audience and shareholders who have joined us this morning or this afternoon, wherever they're hailing from?
Sure. Well, on behalf of Spencer, our Chief Investment Officer, and myself, privileged to be with you. We're working very hard for our shareholders. We are fundamentally excited about where our business sits. We've mentioned the metrics that we've delivered tremendous accretive value on. The tailwinds for our business, I think, are something to not underestimate. Most of the market is very difficult to invest in right now with high rates, a recession looming. We are in a situation where we have buoyant metal prices, expansions underway within our key projects, millions and billions of dollars being spent in certain instances across our development stage portfolio. We're well capitalized, and we expect our growth to continue. I am so optimistic and so excited about where our business stands for our investors. And I just want to make sure that's communicated. We have what we believe is a best-in-class royalty company. We acknowledge that we're not the largest royalty company out there, but we believe that's one of the key opportunities for investors is our relative size and our relative valuation. We're going to continue to be able to deliver outsized growth for our shareholders, and we're looking forward to delivering that.
Thank you, Kyle. You've got great fundamentals and a great delta inflection for those investors who want to get in early. Thank you so much for joining us this morning. And to our audience members, if you have any further questions for the company, you may email them to ir@voxroyalty.com. And just a quick reminder to please fill out the quick questionnaire before logging off. This really helps us and the company to communicate with you more effectively. Thanks to everyone who joined us today, and we look forward to seeing you at the next VID Town Hall Forum.